Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 353rd VideoCast podcast for the week ending July 23rd, 2023. We got a lot of great stuff to cover this week, but as always, family first. Congratulations to Mimi and Annabelle. Mimi's 14U team, Newport Beach Water Polo, crushed the 2026 USA Water Polo Junior Olympics National Championship, winning 19-6 in the gold medal match. Annabelle's water polo team also emerged victorious, winning 10-6 in the national tournament for 12U. Both girls had some incredible goals and steals. Also, this weekend, Annabelle's relay team set a new Southern California record in the medley relay at the age group elite swim meet. After the meet, Coach Rod, Annabelle's swim coach, came to watch Annabelle's water polo team's gold medal match. We really appreciate Coach Rod and the coaches at Newport Beach Water Polo for their support. Congratulations to both girls and their teams on an exceptional season. So there is Mimi right there with her gold medal. And we've got, what else we have here? Here's the congratulations to Annabelle Hayes, Hope Newman, Grace Wang, Julia Zhang for setting a new Southern California swimming team record. 11-12 girls, 400-meter medley relay, 4:36.82. Congratulations to the team. Then you've got, there's Mimi's team, there's Annabelle, there's me and Annabelle, and that's that. Then there's me and Mimi. There's Annabelle with her trophy. There's Annabelle with the mascot. There's Annabelle's team. Want to thank my friend Mike Williams. He catches like literally 80-pound tuna every single week, and he brings some by for the house. It's the best tuna ever. And so we don't cook much, but when that shows up, we get it going. Kudos. I don't know how he does it. Most people catch one of those in a lifetime. He catches a handful every week, and he's got all kinds of stuff. Want to thank Robert Smock for having me out, and Donald for hosting at Baltusrol yesterday, which was absolutely incredible time there. And here's some pictures. There's the incredible historic clubhouse, and played pretty well. There's me and Robert, made 2 net eagles because I got a stroke. We were in a tournament here. This one was unreal. This was the second hole we played. I drained this for natural birdie net eagle, which unfortunately he didn't get it on video. That's in front of the clubhouse. That's one of the par 3s. And what a special place and special event member guest. And here was my favorite goal of the week in the Junior Olympics tournament. Here's Mimi's friend Bryn with the ball. Makes an amazing pass to Mimi. Mimi does her signature turn and burn and picks the corner. Boom. So congrats on an exciting weekend. All right, let's get down to business. Price is what you pay, value is what you get. That's Warren Buffett quote of the week. We're going to cover more of that. Charlie Munger, it's remarkable how much long-term advantage people like us have gotten by trying to consistently not be stupid instead of trying to be very intelligent. We couldn't agree more. Want to thank all of the folks that have been sharing the podcast each week as we continue to grow. We continue to do this for non-clients. And we got a new incredible picture from Eric McLean with his Hedge Fund Tips hat and his North Face jacket. Thanks so much for sending that in. Thanks so much for your support. And all we ask is that each of you share it with one person each week. That's how we grow, that you care about, that would benefit from this content. And as we keep growing, we'll keep putting these out for you 7 years running. To kick our week off here, I'd like to go through a number of the names that we've been speaking about on this podcast over time and kind of zoom out on a day like this when everyone's getting antsy about oil and Trump and this and that. So we'll just go through them and see where we are. This is on a weekly basis. We like to zoom out 25 years, but this time we're only going to do 10 years. I know most people like 10 minutes or 10 days or 10 weeks, but that's not where you're going to make your big money. I love what we're seeing here in advanced auto parts. Put in the bottom last year. Looks like a reverse head and shoulders for all the technicians out here. Measured move takes you up to 38, well over 100. I think you're going to start to hit some resistance over 110, 120. But we'll be celebrating by then, and maybe no comment. But so that's that. You can hardly see these day-to-day blips on these charts. Boeing, we covered we're going to cover the certifications and all that. That's fine. BABA has had a huge move off the lows, dropped below 100, added a ton to new money that came in. Now it's rebounded here on all the AI news. This is going to be a long-term cheapest AI play globally. Baxter, big move off the lows, consolidating. This is going to work higher over time. Crown Castle, we're going to cover in detail today. It's been consolidating here. Now they got rid of the cash-eating small fiber business, and they did a great job of addressing the fears around satellite and direct-to-device and how it doesn't work indoors for phones. Which people forgot about. So we're going to cover that in detail today. So Crown Castle, we're excited about. Cooper Standard, we've got some data on new car sales, which is just a levered play to the top of the cycle. It's probably 2 years out. We'll be doing over 17 million cars. This thing will be doing $10 in earnings, and stock will be even higher. Comstock Resources, we love it at these prices. Gives us an opportunity to get new money into the name. It couldn't be with us at $8 and $9, but they can get it here for the long term. We love it. We covered that one last week in detail. Diageo, best high margin spirit player in the world. Turnaround with Drastic Dave underway. Big move off the lows, just getting started. Disney, we covered a couple of weeks ago. We love it here for the long term. Investing in the high return on capital businesses. Estee Lauder put in the bottom last year. Consolidating, looks very similar to Advanced Auto, going to work higher over time. Etsy feels like it has had a monster move. It did double off the bottom lately, 100% move here from early 2026 till now. But if you zoom out and you look at this, yeah, we could consolidate down to 60, but I think long term this is going to push higher, especially when you look at the cash flows and some of the growth and things that they're executing on. So we remain happy with that. On a daily chart, it's like, oh man, this is going to pull back. But on a weekly and monthly, and when you look at the fundamentals, it's like, nope, this is just getting started. It'll consolidate, but we got to hang tight. Canada Goose, we covered a few weeks ago. Love it at these levels. GXO, again, just setting up for its next leg higher. Hormel, huge move off the lows. 30% move off the lows. Big dividend, consolidating a little bit, works higher over time. National Oil, well, Varco, we're going to talk about rig counts this week. That's had obviously a huge move, consolidated, probably works higher, certainly over the next few years. We'll see over the next few months. Pfizer coming up off that short-term consolidation, now moving back higher again. PayPal got the $60 offer, not adequate. Try $80 plus. Stripe and Advent. And what they don't understand is they're trying to go public. And let me cover that actually. I put out a tweet or two on this subject this week at X. And, PayPal's Stripe's biggest issue and biggest problem is not if they overpay for PayPal. It's actually if they underpay for PayPal. And the reason being is that they have $159 billion private market valuation. If they buy PayPal too low, okay, so why PayPal and Stripe, why Stripe would be unwise to do a deal for PayPal below $80 to $100 a share? PayPal is the public comp for Stripe, and Stripe needs to go public to create liquidity for a lot of funds and LPs. They've been saying they're going public forever. They've been stuck in it. And a low valuation deal destroys their own inflated valuation for the IPO. Second reason Stripe's 2025 EBITDA was estimated to be $1.2 billion alongside an estimated revenue of $6.9 billion in net revenue. They have a private market valuation of $159 billion on $6 billion of revenue and $1.2 billion of EBITDA. This compares to PayPal, which did $33 billion of revenue in 2025. So 7 times, call it just a little less than 5 times revenue, and $7 billion of EBITDA, 6 times EBITDA, and has an enterprise value of 1/3. Okay, the best thing Stripe could do for their IPO is to pay up for PayPal so as to not destroy their own valuation multiple. Furthermore, they need the free cash flow, revenues, and EBITDA to justify such a high current valuation. The biggest risk for Stripe is not paying too much for PayPal. The biggest risk is not paying enough and having their next raise be a down round and a mutiny among owners and funds who own it. At $80 to $100 per share, it heats up the M&A in the sector and primes the pump for them to go public with a growth story at scale and higher multiple than peers. With a bad comp on a lowball deal, they screw themselves. And the other thing is the gun is to the head of Stripe, because if they wait too long, it's going to take regulatory approval and they'll have a new administration that will look not fondly on a deal of this size. So we'll see how this plays out. Believe it or not, best thing that could happen is you wake up and PayPal's at $48 because the deal in the process is off the table and PayPal's going to go run their playbook for the next 3 years, grow the ad business, and then we get well over 100 versus well over 75 or 80. I would think if they do a short-term deal, but time will tell. Okay, let's get back to, here we go. Okay, so that's that. Papa John's just waiting in no man's land until they either close that deal or earnings, when we hear from the former CEO of Wendy's, who turned that around, is turning around Papa John's. They got the Toy Story 5, everything else we covered. QXO, this we've been buying along with Comstock every dollar we get. This is just a bet on Brad Jacobs. Interest rates up, housing gets sold off. The deal's going to be fine. Top bill deal. They're doing everything they need to do to double EBITDA. Technology implementation, I have no doubts in this. And then they also came out and said that they're not going to be issuing new shares for the foreseeable future, which they did at an accretive rate, 20 times EBITDA. They issued the stock, 10 times EBITDA. They bought the business, so that was good for owners, not bad. Semiconductors started its rollover from 671, now at 579. This is the area where everyone says, wow, it's so cheap, I want to buy. Then at 500, they go, wow, this pullback is longer than I thought. Then at 400, everyone's panicking and getting margin calls and getting out. Very cyclical. This is due for a pullback at least, or more. Well, they've already had a correction. It's more than a pullback. I think you're going to get a correction in this crowded sector. Stanley Black & Decker, again, doubled off the bottom, consolidating. This works higher over time. VF Corp, more than doubled off the bottom, consolidating. This works a lot higher over time. And Dentsply Sirona had this monster 50% move from $9 to $14. Now it's pulling back and consolidating ahead of earnings. But this one is going to be exciting. My Sirona, or My Sharona by the knack. So that's the story there. All right, down to data. I was reading and reviewing the Warren Buffett annual letters, and this came from 1963. He was talking about one of his positions in Dempster and the overriding philosophy of how he invests. And I thought this was very interesting, this quote here. Quote, "Our business is one requiring patience. It has little in common with a portfolio of high-flying glamour stocks, and during periods of popularity for the latter, we may appear quite stodgy. It is to our advantage to have securities do nothing price-wise for months or perhaps years, while we are buying them. This points up the need to measure our results over an adequate period of time. And that's what made Buffett so great, because there were, in the 60s, the glamour stocks, the growth stocks, later became known as the Nifty 50. And what we're seeing now in modern day glamour stocks, growth stocks, has been the semiconductors. And here is the COPSI, Korean Equities Index. And I thought this chart was really telling, because you see, obviously, this parabolic move in the COPSI since last year or so, exacerbated by the Iran war, got a final parabolic blow-off leg, and now cracking under the 50-day moving average, and it'll backtest and before resuming its downtrend. And this is a chart that's been around for a couple hundred years. This is the cycle market peak. Okay, we're not here. If you look at this chart, what you can see with the COPSI and semiconductors in general, I mean, look at the similarities. This is just mind-boggling. You have this first move, no one wants it, no one wants it. Then you get this move up here and a shakeout. And then you get another move up here, the thrill, everyone gets excited. That was right before Iran. Then the shakeout. Big shakeout here, and then your final parabolic move to euphoria, which we got into June, and then you get this pullback. And during these pullbacks, so you go from euphoria, where everyone says they're a genius, everyone buying Intel at $140, to this pullback called complacency. And in this chart, it says, we need to cool off for the next rally. Well, this is what I talked about in recent weeks, about the people who bought the top will be the same people buying the dips all the way down. And the narrative will be, this time is different, unlimited compute demand, blah, 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 blah. It's the same every single cycle. And that's what you're seeing right now with these counter trend moves, and these, every time you get the Iran war is back on from Trump, it goes back into the AI only trade. Then you get Google reports last night, and they increased their CapEx spend. So Google crashes or trades down, whatever it's down today, 7%. And the AI trade, the semiconductors and memory stocks trade up. And you'll see this fits and starts. But this chart is broken. This is a cyclical business, and you're going to see people buy this dip all the way down. And the next phase after complacency is anxiety. Quote, why am I getting margin calls? This dip is taking longer than expected. And then after you break down through that, you get panic. Why is everyone selling? That'll be around when Intel's back to $60. I need to get out. And then it will be years of rebuilding the base for the next cycle higher. And at that time, it'll be about robots and changing the world through driving cars and all that stuff that people are playing for now. They're just too early on, and that'll be a real cycle a few years out. But for now, this is broken, and this is a perfect example. And this is a 100-year-old chart that someone used as an example, I guess, years ago on some sector. Anyway, so Google CapEx going down, free cash flow is now negative. We had said that was going to happen by the third quarter. It happened in the second quarter. So there you go. Crown Castle reported. This is Bank of America taking the price target up to $100. We'll cover that in today's article of the week. Cash on the sidelines is at a record low when you adjust for U.S. aggregate investable funds as a percent of U.S. equity market cap. You haven't seen this since the tech peak in 2000. August and September are the only two losing months since 1990, so that we're entering a period of weakness. So buyer beware if you continue to be in those super crowded sectors. Buyer be full of opportunity if you have some defensive exposure or dividend payers as that stuff starts to play out. So here is the Slumer charts. Thanks to our friends over at RBC, as always. S&P moved up to this extension level, consolidating here now, broke below that. This could imply they're looking at two targets, 69.93, 63.16. We'll see. That's concentrated predominantly in the most crowded areas. That's going to be the biggest weight. I think there's going to be money made under the surface while that's happening in defensives, which have been let for dead, healthcare, staples, dividend payers, etc. Hedge fund tips mug. There you go. And then we've got advanced decline line, still showing some strength. Small cap index holding in there. Sentiment in the middle. Let's see, actually, AAII. How did these come out this week? Neutral, bearish 42%. Interesting. Okay. So here's another factor to keep in mind. Let's just get through this. TSX, World Index, again. Emerging markets taking a little consolidation here. Tokyo, Hong Kong moving up. Hong Kong was down, now it's moving back up through this resistance. 10-year yield knocking on the top again due to the Iran situation. US dollar, counter trend move, trending back down. We'll see if it can break below this in coming weeks. Canadian dollar took a breather. Now it's moving back up. Same with euro. Oil's back up to 98 today. Gold has rolled over the last few weeks pretty aggressively. I think it was a 30% correction. Stocks rolling over. That's the semiconductor index. Hit a short-term, I guess, support level. Bounced. I think this is going to resume downward. They're all counter trend bounces. This is where people get sucked in right around that, right around here, complacency. You get these violent bounces on the downtrend, and they just continue to refresh and refresh and refresh. Google broke through this today. Spotify. Occidental oil stocks are going back up, obviously. Stryker, Intuitive Surgical, banks, core. A lot of banks. I think the banks are extended here. Okay, moving along. 1.65 trillion in AI debt that does not appear on a balance sheet. This is hidden off balance sheet. This is confirmed by Nikkei. For Meta, it's 420 billion. For Oracle, 273. You've seen credit default spreads moving out for these about 20 basis points from 60 to 80 basis points to insure the debt. Amazon, 350 billion off balance sheet. Microsoft, 350 billion. And Alphabet, 250 billion. Total reported $1.35 trillion of on-balance sheet debt. Total hidden off-balance sheet is 1.65 trillion. Not your daddy's free cash flow machines anymore. Bank of America bull and bear indicator, extreme 9.6. That's a sell signal. Here's the parabolic move into semiconductors, which is what you see when? During euphoria. We're all going to be rich. That's what everyone was saying about semiconductors in June. Now they're saying we just need to cool off for the next rally. Somewhere between that. In Korea, they're saying, why am I getting margin calls? And now people are thinking, oh, this dip is taking longer than expected. The next leg down, because some people are buying this counter trend bounce, is going to be, why is everyone selling? I need to get out. And that's when you're going to see the bloodletting in the fall, in my view, in those crowded sectors. U.S. crude inventory is lowest in 45 years. Hyper free cash flow turning negative. Hyperscaler free cash flow. Oracle CDS, credit default swaps, record highs from 40 basis points to 180 basis points. That's no bueno. Equity allocation at 66% at the exact wrong time. Highest level going back to the peak in 2021. Cash allocations the lowest. Here's HeartNet's contrarian trades based on extreme FMS positions. Best contrarian trades for surprise hawkish Fed. Long staples. Short semis and healthcare. I don't think healthcare. I like the long staples. I like the short semis. And a peak boom for long bonds. I agree. UK and high dividend yielders. I agree. Short industrials and banks. I'm not sure on the industrials. I think that's on a case-by-case basis. Like Caterpillar's gotten out of its way. A lot of these construction stocks related to data centers are out of control. So I agree on that front. And banks, I think, are way ahead of themselves for sure. So that's that. Insider buying and selling the first half of the year. Massive insider selling relative to buying. Highest level since the 2021 peak. Margin debt as a percentage of nominal GDP. Now, if you measure this against equity value, it gives you a different picture. It's not that extreme. So you can look at it a couple ways. But, there's something to be said for relative to GDP, because nominal GDP is, including inflations, and that's kind of the real economy versus market capitalization. And it does rhyme with some of these consolidation periods for sure. U.S. semiconductors market cap weighting, again, nothing like this since 2000 peak, well beyond that. Korea margin loans outstanding. This is all SK Hynix. They couldn't sell anymore in Korea, so they went unsold to the suckers in the U.S. who bought it, just like SpaceX. Those people are underwater. Alibaba, all the hype around Moonshot and Minimax. Well, guess what? As owners of Alibaba, we own 36% of Moonshot and 17% of Minimax, all the top AI models, in addition to our own Quen, which we own 100% of. We've been saying this for a long time. Alibaba is the cheapest global AI trade, and it's effectively an Asia AI ETF because they've got an equity piece in all the hottest AI startups. Analysts are optimistic about long-term earnings growth to the extent they haven't been this optimistic since the 2021 peak. SpaceX path versus the average path of historical mega IPOs. And by the way, you haven't even had the lockups unwind. So I think for those of you who couldn't get enough SpaceX at 220, if you loved it at 220, if you liked it at 220, you're gonna love it at between 50 and 80. Margins typically peak more than a year ahead of equities. Transport's breaking out, so this is some of the great stuff happening under the surface that no one's paying attention to. Motor vehicle parts and deliveries are up. Motor vehicle sales accelerated up 1.87%. Best since July 2025, up 5.73% year on year. Leveraged ETFs, 4x growth. Again, this is a sign of things you don't want to see if you're in the most crowded trades. Profit margins, similar parabolic move like the 2000 bubble at the peak. Money's moving into international. We like that. Historical and projected CapEx. Shale drillers go 12 weeks without cutting oil rigs, so the rig count's going up. That helps the national oil well Varcos of the world, NOV, which we own. Average S&P 500 stock outperformed the semiconductor index in July. Wasn't hard. Most of them were down 25 to 35%, and people are still buying the dip. Consumer sentiment turning up. This was a big deal that we spoke to about getting exposure to the consumer, both discretionary and staples, playing out. Let's hope this weak spike in oil is a short-term situation. Trump continues to say he doesn't want to be the next Herbert Hoover, so it's on his mind. I think he knows that he's out on the skinny branches with some of the things that he's doing, but always seems to pull it in just at the right time until the time he doesn't, but so far so good. Composite cycle for 2026, this is going back to 1928, generally shows a little bit of volatility in June, some strength in July, end of August, and then weakness September, October before a year-end rally. I think that's a reasonable base case that this year will be similar to previous midterm election years, and we will get some volatility and opportunity in September and October. And people are like, well, then don't you just go all to cash? No, you get into defenses because no one can predict the market. The things that show up, not predicting the market, but actually what's showing up cheap. What shows up as cheap in frothy markets is defensives. And that's what's showing up. So it tells you what you need to know about where things are going. So here's the average monthly performance. August, September gets weak. Margin debt expansion versus contraction indicator. Again, you're getting up to 2021 levels, even if you measure it relative to different metric here. China National Team ETFs see largest inflows in a year. Alibaba is a major investor in Moonshot Kimi, and in turn uses a big chunk of Ali Cloud GPUs, oftentimes competing away. Ali Cloud is growing at 40%. Could be a monster quarter for Alibaba. Semiconductors, earnings, revisions, breadth. Again, same thing you see at each peak. Very cyclical. Semiconductor ETF drawdown. Leverage 40% down. Net flow, volatility on the rise. Bull and bear indicator at 9.6. It's pretty extreme. SpaceX is typical IPO performance at this point of 27 trading days is up 1%. SpaceX was down 23%. Peak to trough decline is already 46% down. Bearish bet starting to build a bit, which probably means you get a little bit of end of June, early August strength before the weakness. Consumer staples positioning low. They're going to do well this fall, and we're prepared. Alphabet posts negative free cash flow. So it happened a quarter earlier than we anticipated. Moving along, Alibaba says new AI model is just second to Anthropic's Fable 5. AI's wider availability is good for China, not great for OpenAI and Anthropic. Alibaba targets NVIDIA's dominant software ecosystem with open source AI stack. China state-owned funds buy nearly $9 billion in shares to support the market, so stimulus is back on. China's tech stock rescue expands Beijing's toolkit. China vows to achieve annual growth target after economy weakens, so they're going to prop up the consumer. Alibaba's the toll taker. CEO PayPal. Yeah, what happened in PayPal this week? So the board came back and said that it was inadequate, the $60.50 offer. So they're, I believe, running a process through Goldman and Evercore. My guess is they do nothing. Stock goes back into the high 40s. We buy more, and they run their turnaround playbook to 150 over the next 3+ years. That would be position A. Position B would be they take an offer somewhere between $75 and $90 a share, which will avoid lawsuits. But that's plan B. And then plan C is they do a dumb deal and they get sued till the cows come home. So that's that. PayPal board sees Stripe admin offer as inadequate. Diageo chair hunts for drinks heavyweights in board revamp. Heavyweight industry experience, which is code for get rid of lightweight appointees. How liquor giant Diageo is taking on beer at the World Cup. They crushed it with Guinness. Vans is turning the corner, and that's good news for VF Corp. So you can see all their cool, expensive, high-margin Vans that have been coming out, and people have been hoovering up. Boeing returns to the air show with flurry of orders on opening day. FAA lets Boeing sign off on 737 MAX, 787 airworthiness certificates again. eBay's acquisition of Depop from Etsy got approved. Artificial intelligence will drive an unprecedented natural gas deficit, this investor warns. Here are the stocks to buy before the crunch. So that is Comstock Resources, in our opinion. That's the only one that matters. U.S. rig count notches longest streak without drop since 2022. Game's just beginning. We've been buying that hand over fist. GM raises full year outlook, says demand remains strong. There's Cooper Standard. Europe car sales jump most since October 2023 on shift to EVs. Why healthcare stocks look like a haven in this market. We agree. That's Barron. Scared of the AI trade. Here are some three investment themes from Goldman Sachs, and they're talking about buying Disney. Disneyland sees wild crowds for trading cards, craziest I've ever seen. So these are the mob type lines that you saw at Vans on Fifth Avenue when they came out with the Satoshi, which sold out in 5 minutes. Bloodbath at Disney has mass layoffs hit with animation movie giant being gutted. So he's cutting the costs out as he promised. Among AI crowds, some investors position for slower hyperscale spending growth. UBS sees hyperscalers CapEx growth slowing to 25% in 2027 and 6% in 2028. 82% in the Bank of America July survey viewed semiconductors as the market's most crowded trade. Big tech needs to justify AI spending as investors dump their stocks. Meta's leasing their AI computing to Anthropic because they can't find a higher return on capital with their internal investments. AI revolution takes on the world's most cyclical industry, which is memory and semis. And finally, our article of the week, Long Live the Crown, Stock Market and Sentiment Results for Newer Readers. Here's a brief overview of the key drivers behind our Crown Castle thesis, the only pure play U.S. tower REIT and high yield income name that becomes increasingly hard to ignore as rates come down over time and capital rotates back into yield. So you can go to hedgefundtips.com. While you're there, click on terms. This is all opinion, not advice. And the 10 key points from the earnings are as follows. First and foremost, Q2 site rental revenue of 967 came in ahead of the 942 million consensus, while adjusted EBITDA of 675 million and AFFO of 1.13 per share, up 11% year on year, topped the 695 million. So we saw the AFFO up 11% year on year. The revenue and EBITDA declines were driven by the Dish and Sprint churn, alongside $3 million decrease in amortization of prepaid rent and a $23 million decrease in non-cash straight-line revenues, which together accounted for the full $41 million revenue decline. AFFO per share grew 11% year on year as the fiber sale proceeds drove a $35 million year-on-year reduction in interest expense and a $14 million increase in interest income. 2, Crown Castle closed the $8.5 billion sale of its small cell and fiber solutions business on May 1st, with EQT acquiring the small cells business and Zio acquiring the fiber solutions business for $8.4 billion in net proceeds after $124 million of preliminary purchase price adjustments. The transaction closed 2 months ahead of the prior June 30th assumption, with proceeds deployed exactly as promised, funding more than $7 billion of debt repayment and $1 billion of share repurchases at an average price of 88.66. The close completes CCI's multi-year transformation into the only publicly traded pure play U.S. tower operator focused exclusively on the U.S. market. 3, Dish terminations drove a $49 million year-on-year headwind to site rental billings in the quarter, and with Dish Wireless now in bankruptcy, management has pivoted from its original lawsuit, now suspended, to pursuing its $3.5 billion contractual claim through the bankruptcy court. Crown Castle has been appointed to the Unsecured Creditors Committee and believes the bankruptcy path will resolve faster than a traditional lawsuit would have. A second recovery avenue runs through the FCC-mandated $2.4 billion escrow account tied to the EchoStar spectrum sales to AT&T and SpaceX, which sits outside the normal bankruptcy waterfall and is earmarked for infrastructure vendors, where CCI believes it holds one of the largest claims. Full-year guidance continues to assume zero contribution from Dish. 4, organic contribution to site rental billings was $38 million in the quarter, or 3.9% organic growth, excluding the unfavorable $49 million and $5 million impacts from Dish terminations and Sprint cancellations, respectively. Growth rises to 4.2% once Dish is stripped from the prior year base, an acceleration from 3.7% in Q2 2025 on a comparable basis. The underlying components were healthy across the board, with $15 million from core leasing activity, $25 million from escalators, and $5 million from other billings, partially offset by $7 million from non-renewals. Management continues to view 2026 as the trough year for organic growth, with acceleration expected thereafter as Sprint churn rolls off and new spectrum deployments ramp. 5, management addressed the investor concerns around the satellite threat directly, making the case that direct-to-device offerings remain a complement rather than a substitute. 90% of mobile usage occurs indoors or in vehicles where satellite struggles, given its need for a clear line of sight and signal, 10,000 times weaker than terrestrial. Satellite operators also access only tens of megahertz of spectrum versus hundreds for each major carrier, and a single beam covers 100 to 600 square miles versus 3 to 20 for a terrestrial cell site, meaning terrestrial sites support 30x more users per megahertz of spectrum. When asked whether carriers had altered any rural coverage builds or renewals in response to recent satellite partnerships, management indicated they had not, a sign the perceived threat has yet to surface in customer behavior. 6, Crown Castle ended the quarter at 6.3 times net debt to EBITDA, squarely within its 6.0 to 6.5 investment grade target, with net debt of $17.1 billion now sitting at 100% fixed rate, a weighted average maturity of 7 years, $4.5 billion of revolver availability, and $1.25 billion of cash. The $7.2 billion of debt repaid since the last quarter was concentrated in the highest cost, most rate-sensitive obligations, including $5 billion of floating rate debt across the commercial paper program, revolver, and term loan, alongside $500 million of open market repurchases and $1.75 billion of maturing unsecured notes. Management reiterated its commitment to an investment-grade balance sheet and right-sized the revolver from $7 billion to $4.5 billion to better align with the leaner standalone business. 7, CapEx rose 48% year-on-year to $59 million, split between $52 million of discretionary and $7 million of sustaining CapEx. The increase was driven almost entirely by a $20 million step up in land CapEx, with purchase of land interest more than doubling to $36 million from $16 million a year ago. CCI now owns the land under 43% of its towers, weighted by gross margin, and increasing that share is the primary lever behind management's targeted 200 plus basis points of future margin improvement, supported by an 11% land cost gap versus peers, American Tower and SBA, that management aims to close over the next couple of years. Management emphasized the ground lease buyout program will remain financially disciplined, targeting paybacks that translate to returns well above its cost of capital. The step up in land spend was also the primary driver of lower reported free cash flow in the quarter. 8. Crown Castle paid $460 million in common stock dividends during the quarter, or 1.0625 per share, unchanged on a per share basis year on year, and yielding 5.6% at current prices, with the payout held flat and AFFO growing. Coverage continues to improve, with management targeting 75 to 80% payout ratio and expecting the dividend to grow in line with AFFO over time. 9. Management pointed to 3 drivers of long-term growth, starting with mobile data demand, where per smartphone U.S. consumption is projected to grow to more than 2x over the next 5 years, from 25 to 50 gigabytes per month, alongside a 3x increase in AI-driven uplink traffic. The spectrum pipeline is the largest to date, with at least 800 megahertz set to be made available for commercial use in coming years, including upper C-band and the 2027 auctions, plus another 165 megahertz targeted for auction between 2026 and 2027. Edge compute is the newest opportunity, with CCI running trials to monetize this. Over 40,000 sites for smaller deployments requiring less than 0.2 megawatts of power. An incremental revenue stream that requires no capital investment on CCI's part and uses the power and backhaul already in place at existing sites at a time when large data centers face multi-year construction and power delays. Management described the Edge trials as early but promising. And 10, management raised full year 2026 guidance, lifting the site rental revenue midpoint to $3.85 billion from 8.55 from 3.85, and net income from $870 million from $830 million, diluted EPS to 2.02 from 194, and AFFO from 1.975 billion from 1.97 billion. Adjusted EBITDA held at 2.69 billion, and AFFO per share remained at $4.59, range of 453 to 465, as 15 million of cost reductions and 5 million of higher site rental revenue were offset by a $20 million reduction in service contribution on softer carrier activity. Underlying organic growth guidance ticked up to 3.4% ex churn, or 3.6% with Dish Strip from the prior year base, and management reiterated 2026 as the low point for organic growth, noting that more than 90% of full year organic growth is now contracted, compared to 80% at the start of the year. So we covered the highlights from the earnings call and the deck. You can find them at hedgefundtips.com. Click on terms, opinion, not advice. And that's that. Fear and greed is at fear. National Association of Active Investment Managers, still all in, just in time for some consolidation. That's the story there. Moving on to biotech earnings. Top 30 weights revised down 3.67% in the last 60 days for this year, 67 basis points for next year. And equal weight up 2.67 for this year, down 48 basis points for next year. As far as, let's get this, countries. They're all United States. So this week we had pretty light economic data week. U.S. crude inventories was actually a build of 2 million barrels. Initial jobless claims came in less than expected. And tomorrow we get the PMI numbers, which will be interesting to see. Earnings, 10% of the S&P have reported, 88% have reported positive EPS surprise, 85 positive revenue surprise. Year-on-year growth is supposed to be 24.7%. And the 12-month forward PE is currently at 20.3 for the S&P 500. You can see what is happening with estimates are ticking higher. So we'll continue to keep an eye on that. Next week's podcast, I'm in New York to do a bunch of TV. So this week we're going to keep it short. We'll get to our AMAs in a second. Next week's going to be a lot longer because we've got 6 or 7 spots coming Monday through Wednesday. And then we'll be in Paris the following week. So any new or existing clients in Paris that want to meet for a coffee, reach out through the website, and we'll catch up. And then in the Hamptons on the way back in early August, I'll be seeing a couple clients out there and playing some great courses as well. So let's get down to the questions from our incredible audience. The first one comes from Sid M. ASTS, been hearing too much about it recently, and given it's ran up, haven't looked serious, but the sentiment is that it's undervalued. The sentiment is always undervalued. If you look back at what happens at these periods, well, you can go back to that euphoria chart that I showed you on the first pullback. Everyone thinks it's cheap after it went parabolic. Look, here's the deal. You can take a flyer on names like this, but it's just gambling. There's nothing more than gambling on this. It's losing $1.3 billion a year in free cash flow on $70 million of revenues, and they have 6x the share count in just 3 years. So it went from 50 million shares to 300 million shares. The story here is the satellites to compete with SpaceX, and people are saying, well, if SpaceX is worth $1 trillion, well, this must be worth at least $500 billion. Look, at the end of the day, the business is doing 70 million in revenue. It's got an enterprise value of $18 billion, market cap of 23 billion, and losing over $1 billion of free cash flow. Look, you can bet on a basket of these, and 1 out of 100 is going to be 1,000x. 99 out of 100 are going to zero. So I know people love this, and I know it's got a sexy story, and it's timed perfectly right around SpaceX, but this is not run by Elon Musk, so it's not going to get that premium. Is it in a good business at a good time? Yeah. Is it a good price? No. So we'll leave that to other people. Hopefully they gamble and it's the 1 in 100 that's 100x. But I wouldn't hold my breath on this one. Matthias Mule, Samsonite, SMSGY. All right, let's take a look at this one. I think it's due for a bounce. I don't think you're going to get a double, but I also don't think you're going to get hurt. Let's just take a look at the balance sheet real quick. $600 million of cash, 1.6 billion of debt. Free cash flow is pretty solid. Yeah, I've got no problem with this. I think you'll be okay here. 600 million of EBITDA. Get a dividend while you wait. It's not the type of business I'd generally be excited to get involved in, but I could definitely see how it could work. So it's fine. Michael Schonauer. Oh, okay. Yeah, I will call you regarding that. Gaspar Bedeau. Clarine, SAS, CLARIAN. E. Okay, it's not going to come up here. Yeah, the good news is the fundamentals are improving. The bad news is they increased the share count a lot. That might be related to an acquisition. It's a lot of a 3.5x the share count, and they doubled the cash flow after but then they 3.5x. What do they do? Healthcare facilities and services, short stay nursing homes. Yeah. Uh, yeah, it's a lot of dilution. And that's been their history. 34, they doubled the share count. So you'd have to study. This is probably a deal that they did. You'd just have to study if it's been accretive per share or not. Let's see, income statement. My general spidey sense is I want to pass on this one. So, but the thing to figure out is to go back to the conference calls during that period when the share count went up 3.5x and see if the story sinks and whether it was an accretive deal, if it was a deal at all, or they just raised equity and diluted everyone, and why. But management that has no problem doing that tends to do it a lot. So you think you're getting a good deal and the business is improving, and then all of a sudden your slice of the pie is half. And I don't like partners that do that to me. All right, that's that. Next, Robert Wartanian, Jubilee Foods Corporation. Oh, Jollibee. Yeah, I've heard about this. Is this cult following fried chicken? Hmm. See if I can get this in English. It's a lot of shares. Yeah, I want to spend a little time on this one because let's see, quick serve, smash burger. Oh, this has a lot of different restaurants. Okay, hold on for a second. Jollibee Group. This is it. Yeah, it's the fried chicken. Number one best fast food fried chicken in the U.S. 3 years in a row. I'm not going to be back in California for a couple of weeks, so the answer to your question is I want to do some work on this because I have been hearing about this and it looks interesting. So good work, Robert. Yeah, this one could be a double if everything checks out. You're taking a little more risk with the Philippines business for sure, but I think there's probably something here worth looking at. So far, looks okay. Alexis, confirmatory stuff on Comstock. Most of these guys copy us. Let's see, GI. Would you say 1 million is a good size in order to invest for oneself full time? No way. No way. You can't make enough to live off that. I mean, even if you're doing 30% a year, I mean, 300 grand's not going to pay you much. You need probably 10 or 20 to even think about it full time. Kavita Yu. Do you think Disney's fixed the previous issue with management setting targets as a basic for executive compensation? Real issue in the past. I don't know if it still is. Yeah, they're on the right track. They picked the right guy. John H. Leggett and Platt we've covered a bunch of times. I think they got bought. Let's see. Yeah, it's acquired already. 2.5 billion all stock transaction. This is exactly what you don't want to see from a board. They basically stole 4x from their shareholders. So you missed that one. Well, you didn't miss anything, but they screwed you. They screwed their owners. Thoughts on Wolters Kluwer in Amsterdam, WKL? Financials are fine. It's software solutions. We stay away. Welcome to the podcast. Johnny S. Boston Scientific, we cover every week. I think it's too early. Chan Chitwood. Son absolutely loves you and the advice, opinion, not advice that you've been giving him on getting started with investment. Appreciate your thoughts on Lamb Weston. I like this one. Yeah, I like this one. That's a good one. Declan English, FMC, high risk, high reward. Treat it like an option. It can go bankrupt, but if it doesn't, you're going to make 4 or 5x. So it's obviously not going to be a 10% position in your portfolio, but wait, FMC rather. Yeah. Super levered balance sheet, but if they don't go bankrupt, you're going to get a 5-bagger. So size it accordingly. So it would be an option position 2-3% max, and you have to be perfectly willing for that to go to 0, but it might add 1,500 basis points of performance. Embecta Corp, EMBC. Revenues are down. Share count's up. What do these guys do? Diabetes. Yeah, I mean, let's see. Are they going bankrupt or not? If they're not going bankrupt, you might get a trade. This is just not a quality of business I want to be in. So let's see. $1 billion of debt, 200 million of free cash flow. Yeah, it's not for me. I think it works as a trade. I understand why you're looking at it. I just don't want to be involved. Sean Rogers. We're holding. We hope the bid gets rejected and that they just continue to execute. NBIS from Mona D. Hard pass. Welcome to the podcast. John Kroner. Thanks, John. Wishing me a happy birthday. Appreciate that. That was yesterday. How do you decide whether to allocate incremental capital to new positions and or size existing ones? We're always adding to existing ones. For us to start a new position, we either have to have harvested a position that at a level that we decided we were going to harvest it before we got in, or it has to be so compelling that it's worth taking an existing position out of the portfolio to put it in. But just adding positions to have 50 stocks and underperform is not what we do. Good question. Zach T. Has Trump lost the plot? Crude is now back at 85, well, 90 today. As the Iran war is left unresolved, all while he starts another round of tariff threats. Definitely not making it easy for the Fed. If a hike happens, are you not worried of a 12% drawdown across each name from here? Number one, I can't control what Trump is going to do. I can control buying businesses with margin of safety. If I get a short-term mark-to-market of 12%, which I have no idea how you came up with that number, I could care less. If I have additional capital, we'll buy more. If I don't, we'll ride it through. I know what the intrinsic value of these is. The mark-to-market on a day-to-day or week-to-week basis has no impact on anything other than creating opportunities to add more, or in the case of when it's overbought and trading well above intrinsic value, opportunities to get out. So the only thing we look at volatility for is opportunities to add. If the stock is down, opportunities to get out. If the stock is up too much on a day-to-day basis, we could care less because we know what the intrinsic value is going in and we know what the expected intrinsic value is where we're going to be getting out. And the short-term noise about what Trump does or doesn't do or this or that is all short-term noise and we could care less. Robert Tobianski, happy birthday. Nice wishes. Thank you very much. And all the people that sent me DMs on the social media, thank you so much. I appreciate it. Know that I got it, read it, and appreciate it. So Alex Resnick, Jersey Mike's IPO. We don't do new paper. So $8 billion valuation. Blackstone's the seller. 724 million in revenue with 55 million of net income. Is that it? God, I thought it was a larger business than that. $55 million. Yeah, no, I'll be hard pass on that, by the way. I love the product. Like, is it AI Jersey Mike's? Like, how do you get to that valuation? 20 times 8. Is that 160 times earnings? I mean, yeah, it's okay. It's growing at 50% earnings, but like, oh my gosh. All right, Alex Resnick. Oh, we covered that. Next, Luke Wheeler. Celsius Holdings. It's a tricky one. I've looked at it a million times and I've not done anything with it. And I think I'm going to continue to hold that position. And I can't really get comfortable as to why. It's just spidey instincts after doing this for a long time. But I like the product there too. I think the thing is crowded, but they're still growing. What did they do here? Did they do a deal? Let's see. Rockstar Brandon. Yeah, I don't hate this one. I'm just not going to be involved. Let me just see here. Income statement. Stock-based comp. It's a little high. I don't hate this one. I got to be honest. I don't hate it. I think if you could get it around 25 and hold it for a while, you're probably going to be okay there. %20 earnings growth. Yeah, I don't hate this one. It's not bad. Good job. Nicholas Shantz. We've covered that on AI. All right, good. So with that said, next week we're going to have a long call. We'll be back same time. We might be back a day early because I think I fly on Thursday. But it's going to be our normal long 2 hours with a lot of great media and a lot of great updates. So we'll see you next week. In the meantime, make it a great one. Bye for now.